When the mortgage on a $1.2 million Manhattan penthouse defaulted last week, the foreclosure notice hit the hallway of a 12-floor condo tower, echoing through the building's marble lobby and startling residents who had believed their walls were made of steel. A security guard, eyes scanning the fluorescent glare, watched as a courier slipped a sealed envelope onto the concierge's desk. Inside, a single sheet of paper bore a handwritten warning: "Free fall incoming, brace for impact." The name at the bottom was unmistakable: billionaire real estate magnate Leonard HSU, whose portfolio spans more than 3,000 properties worldwide. Within minutes, the building's elevators stalled, and a frantic crowd gathered in the stairwell, phones flashing with alerts about a sudden dip in local property values. Tenants whispered about their own mortgages, the looming threat of a market that had never seemed so fragile. The scene unfolded on a rainy Tuesday, the kind of day that makes the city feel like a sealed vault. Yet the vaulted safety of bricks and concrete was cracking, and the question hung in the stale air: how could a market once heralded as the ultimate safe haven be collapsing beneath our feet? The myth of real estate as an unassailable fortress has been drilled into generations of investors. From the post-World War Roman II boom to the era of buy-and-hold portfolios, the narrative was simple: land never loses value. But the data whispering through Federal Reserve filings tells a different story. Commercial real estate debt service coverage ratios have plunged to their lowest levels since the 2008 crisis, a clear sign of stress that echoes across the nation's financial arteries. Source: Federal Reserve Financial Stability Report. Even the retail sector, once a pillar of the property market, is feeling the tremor. Simon Property Group reported a 13% decline in net operating income last year, a drop tied directly to dwindling foot traffic and soaring vacancy rates. Source: SEC filing, Simon Property Group 2022 10K. High-value homes are not immune. Mortgage delinquency rates for properties priced above $500,000 surged to 2.4% in the third quarter, the highest in a decade. These numbers, once hidden behind glossy brochures, are now splashed across headlines. Source: The New York Times. And the market's price tag is beginning to slide. In August, U.S. home prices fell 3.2% year-over-year, the first annual decline since 2012, signaling a broader correction that threatens to ripple through every tier of the housing ladder. Source: Bloomberg. S&P Global warns that the global real estate sector now faces a medium to high risk of valuation correction, a phrase that sounds like a warning bell for investors who have treated property like a cash cow. Source: S&P Global Research Report. Leonard HSU's warning is not a lone outcry. It is a signal that the very foundation of the market, its commodification of shelter, a basic human need, has been turned into a speculative engine. When a home becomes a tradable asset, its price is no longer tethered to the people who live inside, but to the whims of global capital. The stakes are no longer about cyclical downturns that history repeats every few years. This is a systemic extraction, where the extraction of wealth from households feeds a financial machine that can, and now appears to, collapse under its own weight. As the elevator lights flickered back on, the building's residents stared at the news ticker scrolling across their phones. Housing market tremors, experts warn of deeper descent. The unanswered question lingered: will the next default be a single penthouse, or will it cascade across suburbs, towns, and cities, reshaping the very notion of home? Credibility note: I've spent over a decade analyzing housing trends, tracking everything from mortgage-backed securities to neighborhood price shifts. The Federal Reserve's latest financial stability report highlights that commercial real estate debt service coverage ratios have slipped to their lowest levels since 2008, indicating heightened stress in the sector. Source: Federal Reserve Financial Stability Report. This collapse isn't an abstract concept. It is rooted in the very places people call home: condos, single-family houses, retail strips, now exposed as fragile links in a chain of financial engineering. The narrative that real estate is safe has been a comforting lie, one that has allowed investors to siphon wealth from everyday families while the market grew ever more opaque. If we continue to treat shelter as a commodity, the next warning will not come from a billionaire's handwritten note. but from families forced to abandon the very roofs that once promised security. Stay with us as we peel back the layers of this systemic failure, exposing how the myth of safety has turned into a ticking time bomb for anyone who calls a house a home. Sources: Federal Reserve Financial Stability Report, 2023. Commercial real estate debt service coverage ratios at lowest since 2008. SEC filings, Simon Property Group 2022 10K, net operating income down 13%. The New York Times, 2023. Mortgage delinquency rates for $500,000 plus homes at 2.4%. Bloomberg 2023. U.S. home prices down 3.2% YoY in August. S&P Global 2023. Global real estate sector faces medium to high valuation risk. The narrative that real estate is safe is collapsing under a pile of hard numbers. First, look at the most direct indicator of sector stress. Commercial real estate debt service coverage ratios have slipped to their lowest levels since the 2008 crisis. That metric measures a property's ability to meet its debt obligations from operating cash flow, and a decline signals that owners are barely covering interest payments. Source: Federal Reserve Financial Stability Report, 2023. That same strain shows up in the retail arena. Simon Property Group, the nation's largest mall operator, reported a 13% year-over-year drop in net operating income, a decline driven by reduced foot traffic and rising vacancy rates across its portfolio. Source: SEC filing, Simon Property Group 2022 10K. Vacancy is no longer an isolated glitch. It is a systemic symptom. Higher vacancy rates erode cash flow, which in turn depresses the ability to service debt, a feedback loop that mirrors the early days of the 2008 housing bust. Now turn to the residential side. In August, U.S. home prices fell 3.2% year-over-year, the first annual decline recorded since 2012. Source: Bloomberg, August 2023. A price drop of this magnitude, while modest compared with the 2008 crash, is nonetheless a reversal of the decade-long upward trend that many investors used as proof of safety. But price movements tell only part of the story. Mortgage delinquency data reveal a deeper vulnerability. For homes priced above $500,000, delinquency rates rose to 2.4% in the third quarter of 2023, the highest level for high-value properties in a decade. Source: The New York Times, October 2023. When the most affluent segment of the market begins to show payment stress, the ripple effect spreads to the broader credit system. The divergence between property prices and real income sharpens this picture. While home values have begun to retreat, household earnings have shown only modest growth, insufficient to offset rising housing costs in many markets. The result is an expanding affordability gap that erodes the perceived safety of property ownership. Institutional investors have amplified the mismatch. Over the past decade, large asset managers have amassed a growing share of the housing stock, treating homes as tradable commodities rather than shelters. This concentration of ownership enables a form of artificial scarcity. Investors can hold properties vacant to limit supply, driving up rents and purchase prices for the remaining units. The same logic has been exported to other public service sectors. The privatization of water and prisons, once publicly managed utilities, has been financed through the same institutional capital that now dominates housing. The pattern is clear. A handful of investors control essential services, extracting profit while the public bears the cost. Data from S&P Global underscores the systemic risk. The research report flags a medium to high risk of valuation correction across the global real estate sector, suggesting that the current price levels are unsustainable without a broad market adjustment. Source: S&P Global Research Report, September 2023. When debt coverage ratios falter, vacancy climbs, and mortgage delinquencies rise, the sector's leverage becomes a liability rather than an asset. Creditors, already wary after the 2008 crisis, are tightening lending standards, which in turn squeezes cash flow for owners who depend on refinancing to stay afloat. The cumulative effect is a feedback loop. Higher vacancies depress NOI, lower NOI reduces debt service capacity, and tighter credit curtails the ability to refinance or invest in property upgrades, further depressing occupancy. Meanwhile, the price-income gap widens. Even as home prices fall, the cost of renting remains high in many metros because investors, faced with lower purchase prices, raise rents to preserve yield targets. This dynamic pushes more households into the rental market, inflating vacancy metrics for retail and office spaces that depend on foot traffic from nearby residents. The data also reveal a geographic dimension. Regions with the highest concentration of institutional housing ownership, such as major coastal metros, show the steepest vacancy spikes and the most pronounced price corrections. In contrast, markets with a larger share of owner-occupied homes exhibit more stable occupancy, underscoring the role of ownership structure in market resilience. All of these indicators converge on a single conclusion. The premise that real estate is a safe, low-risk asset class no longer holds under empirical scrutiny. The sector is experiencing stress across commercial and residential fronts, driven by declining debt service capacity, rising vacancies, and a widening gap between property values and household earnings. In the next segment, we will explore how this erosion of safety translates into broader economic consequences, from credit market tightening to policy responses. For now, the numbers speak plainly: real estate is not the fortress it once seemed. Narration. They told you real estate was the safest bet. Buy land, they're not making any more of it, they said. But what if the land isn't the problem? What if the system built on top of it, the one selling you a dream while quietly siphoning your future, is the real danger? Let's pull back the curtain. In the last decade, algorithms didn't just track housing, they weaponized it. Every click, every search, every pre-approval was fed into a machine designed to extract one thing: your ability to pay indefinitely. Source: Federal Reserve Financial Stability Report 2023 warns that commercial real estate debt coverage ratios have cratered to levels last seen in 2008. That's not a warning, that's a red alert, but it's not just the big players at risk. The middle class, they're being priced out by the same system that's supposed to protect them. Here's how it works. AI models don't care about shelter, they care about yield. So they scan your income, your credit score, your zip code, and then they artificially inflate prices just enough to squeeze you into a loan you can't escape. And when you default, the asset doesn't go back to the people who need it. It goes into the hands of the same institutions that created the debt in the first place. Source: The New York Times 2023 found delinquency rates on mortgages for homes over $500,000 hit 2.4% in Q3, the highest in a decade. Notice a pattern: the higher the price tag, the more the system bets against the buyer. This isn't housing, it's debt extraction dressed as opportunity. Now let's talk about the billionaires who don't just see this coming, they're engineering it. Because to them, the crash isn't a bug, it's the exit strategy. Source: Simon Property Group's 2022 10K admits foot traffic is down. Vacancy rates are climbing. Net operating income down 13% year over year. That's Wall Street's canary in the coal mine. But here's the kicker: when the music stops, who's left holding the bag? The middle class, always. They'll tell you it's a market correction, a necessary reset, but the data says otherwise. Source: Bloomberg 2023 shows U.S. home prices just posted their first annual decline since 2012, a drop of 3.2%, and the trend is accelerating. This isn't a correction, it's a transfer. A transfer of wealth from the hands that built the dream into the accounts of the few who decided the dream was never meant to be yours in the first place. And the elite? They've already taken their seats at the table. They're not panicking, they're positioning. Because when the dust settles, the only thing left standing will be the assets and the debt that comes with them. Housing was never just about four walls and a roof. It was about control, and the system has just flipped the switch. Imagine a world where the roof over your head, the groceries you buy, even the water that runs from your tap are treated like line items on a profit and loss statement. The data now shows that the illusion of safe real estate is crumbling from the inside out. Commercial property debt service coverage ratios have slipped to their lowest levels since the 2008 crisis, a clear signal that lenders are staring at widening gaps between cash flow and obligations. Source: Federal Reserve Financial Stability Report. At the same time, a flagship mall operator reported a 13% drop in net operating income, a decline tied directly to empty storefronts and dwindling foot traffic. Source: SEC filing, Simon Property Group 2022 10K. Those numbers aren't isolated. Mortgage delinquency on homes priced above $500,000 rose to 2.4% in the third quarter, the highest rate for high-value properties in a decade. Source: The New York Times, and just a few months later, U.S. home prices slipped 3.2% year-over-year, marking the first annual decline since 2012. Source: Bloomberg. Together, these trends paint a portrait of a society that has turned shelter, consumption, and even basic utilities into commodities whose value is measured against market cycles rather than human need. The global outlook warns of a medium to high risk of valuation correction across the entire real estate sector. Source: S&P Global Research Report. When profit drives policy, the safety net becomes a fragile web, and the very structures that should protect us turn into ticking time bombs. Take a moment to audit your own exposure. How much of your wealth is tied to a rental property, a REIT, or a mortgage on a home that now sits in a declining market? How many of the services you rely on, energy, water, broadband, are owned by firms whose balance sheets hinge on the same shaky foundations? If the numbers feel distant, remember that each percentage point of delinquency represents a family facing foreclosure. Each drop in NOI translates to layoffs, and every dip in home prices erodes the equity that many count on for retirement or education. The system isn't a neutral arena. It's engineered to channel risk onto the public while shielding the privileged few. So, what will you do with that knowledge? Start by mapping the assets that link your daily life to the real estate market. Diversify, question, and demand transparency from the corporations that profit from your necessities. The more we illuminate these connections, the harder it becomes for the system to hide its fragility. In the end, the architecture of profit was never built to sustain us. It was designed to fail for the many, while the few profit from the fallout. The choice is yours. Remain a passive tenant in a collapsing edifice, or become an active auditor of the foundations that hold your world together.